All right, well, 2 out of 3 large fund managers are bracing for a low growth, low inflation economy, but most say a recession is not on the immediate horizon. That's according to Bank of America's Fund Flow survey. Now, fund managers are worried about secular stagnation, which is 2 quarters of negative growth instead of a recession. Joining us now is Patrick Schaffer, Global Investment Specialist at JPMorgan. Patrick, thank you so much for joining me today. Just quick, what is your reaction to the Bank of America survey? I mean, do you necessarily agree with it?
I think first quarter earnings will be negative. I think first quarter earnings will probably come in about negative 4% for the S&P 500. Really interesting. That's on top of 6% revenue growth. So we're seeing healthy top line, but bottom line, we're seeing some margin compression through the income statement. That's a function of a couple of things: stronger dollar, weaker oil, some weakness out of a couple of big tech companies, driving earnings a little bit lower year over year. But it's really important to keep into context. That's versus 25% growth in the first quarter of 2018. Mm-hmm. So looking at it through a little bit of a longer term lens, earnings remain very healthy. And do I think that we see the second quarter earnings to be negative? I don't necessarily see that at this point.
So Patrick, stocks pushing all-time highs, not too far off, I should say, from the all-time highs. You say now's the time to look around and gauge how healthy this market is overall. I know you're just talking about earnings. How healthy do you think this market is? Are we at all at risk of some sort of pullback in the coming months?
Sure, we're always at risk of some sort of pullback in the coming months. I think understanding, the severity of that and really trying to pay attention to things that drive the longer term dialogue, which is earnings and GDP. I think if we focus on earnings and GDP, we can understand that earnings likely to be positive this year, even though negative in the first quarter. We do not see a recession on the horizon. I think we can probably look out 12 or 18 months before that's probably near term. So if we were to see pullbacks, I think they would probably be relatively short-lived, like the pullbacks that we saw in February, October, and December of last year.
Mm-hmm. Do you think it's the multiples that are driving the markets higher? Is it earnings? What do you think it is?
Yeah, it's multiples.
Multiples?
Yeah, it's multiples. We've seen multiples expand this year following the pretty dramatic pullback that we saw in December of last year. And really interesting, while markets are back to essentially September highs, 2020 earnings have continued to bleed a little bit lower. And focusing on management commentary during first quarter earnings season is going to be really important to understand how the market's going to set up near term.
BlackRock CEO Larry Fink, he was talking yesterday, and he said that we're at risk of a melt up, not a meltdown. Do you agree with that?
I understand what he's saying.
Yeah.
Fund flows have been light, volumes have been light. There's a lot of cash on the sidelines. Investor sentiment remains relatively muted, despite the fact that the market just ran 25% in 3.5 months. Mm-hmm. And so could there potentially be that a move of cash off of the sidelines into markets and pushing the equity market higher from here? Yes.
The fear of missing out trade. Patrick, one sector that's down significantly from its 52-week highs is energy. We've been talking a lot about, we have seen somewhat of a rebound though, but still significantly below those 52-week highs. Are you seeing investment opportunity within that sector?
We are. Now, it's, I think, important to understand first why it's happened. Mm-hmm. Global growth has decelerated versus last year, right? That's what started a lot of the pullback in equity markets in the fourth quarter. It's also what caused the Fed to pivot the way that they pivoted. Now, energy prices have rebounded pretty significantly. They're still down year over year. But if one has a view that we're not going to hit a recession in the next 18 months or so, energy stocks should be fine as long as oil remains kind of above 60.
What about the global picture? Are there opportunities outside of the U.S. to put your money right now?
Yeah, I think emerging markets is a really good non-consensus place to look. We've seen significant improvement in data out of China, particularly the March data set out of China, reinforced by first quarter GDP number today at 6.4%, which was above expectations. If you're looking for a non-consensus place to put money, I think emerging markets, you can get premium growth at a discounted valuation today.
What about Europe? Stay away from it for right now?
I think Europe's a little bit tougher of a story, and it has been for a while. I think if I were looking for an outside of the United States place to look, it would be emerging markets.
All right, Patrick Schaffer, thank you so much for joining me today.
Thanks, Shauna.